Welcome to this module on cyclicity, the C word. And this is something which is very important to your understanding of how markets ebb and flow, especially in trending markets, I'll have you know. Now, cyclicity actually represents one of three things that the market can do. They can either trend, range, or chop, and we are only really interested in markets that trend and demonstrate the C word. Yes, as I've just mentioned, cyclicity, or range for that matter. But in a trending market, we want high highs and high lows in an upward trend, or lower highs and lower lows in a downward trend. They can either trend up or trend down. Either way, we want the characteristics to demonstrate higher highs and higher lows if going up, or lower highs and lower lows if we're going down. We will soon demonstrate this, don't worry. But we do actually like cyclicity because it gives us the predictability in a market of complete and utter chaotic randomness where anything can happen at any time. Now that is the Forex market, and the market at large for that matter. We don't know what's going to happen next, but based on probability, down to our technical analysis, and what is likely to happen, we have our edge. And it will not come as a surprise that in an upward trend we will look to buy or go long if the trend is our friend by making higher highs and higher lows. Or in a downward trend, we'll just simply want to do the same again, except go short with the lower highs and the lower lows. Or lower peaks and lower troughs, as you will witness in a minute. So as I've just mentioned, in an upward trend, we want clear higher highs and higher lows. This blue line is a moving average, by the way. So here we've got the price action. We've got phase 1 here, and phase 2, where if you trace back to the moving average. Phase 1, as you made a higher high. This peak here is higher than this peak. And we've got a retracement back to the moving average. This is phase 2, where we've got the retracement. And then we've got phase 1 again, where we're making a higher high. And where we've got higher peaks, the high points here, otherwise known as higher highs, and we've got higher troughs, this is a clear upward trend. And we can see that we've got predictability here, and we can reasonably say, based on what's happened in the medium term or short term, that things are likely, more than likely, to continue in the direction they have already just gone, i.e. in an upward trend, making higher highs and higher lows. In this instance, we're respecting the 20 moving average here. We've had 2 tests of it. I know it's just a diagram, but we can reasonably say that as we've been making higher highs and higher lows twice already, and intersected with this moving average, we can expect to go long, and we've got a very high probability of this instrument going long as soon as it intersects back or comes back to retest this 20 moving average and subsequently make a higher low. And of course, all is very well and good. We can make hay while the sun shines, essentially, and looks to go long when we've got the confirmation that we've got cyclicity making higher highs and higher lows. But what happens if we get a lower high, for example? We've got higher highs and higher lows like so. We come back to the 20 moving average. We're looking to go long in advance of our higher high, but we make a lower high. That is a real early warning sign that the trend is starting to bend, and the momentum of buyers is starting to get less and less, and the bears are coming into the market. And I would never look to go long after we've made a lower high, because it's very unlikely then that we're going to be making a higher high thereafter. What we'll generally see is a move downwards, and it's a real warning sign. So if you see this, even though it might be frustrating, you might not have traded for a while, and you see that, okay, we've got 2 higher highs and higher lows, but then, damn almighty, we've got a lower high. Treat that as an early warning sign. You might have gone long here, and you might have unfortunately not met your target, which would be the previous swing high or a higher high. But at least you would have managed to trade, and we'll talk about that a little bit later, to the point where you would be out at break even. But if you're just looking at the charts and you're not even in the trade, and you see an upward trend, it's made a lower high, i.e. a lower peak here, compared to the higher peaks like so, then it's a danger sign, it's warning. Time to get out, time to pack your bags. Do not buy it, it's not worth it. So if we are going to treat the trend as our friend, we want a nice steep trend. The steeper the better, as we say. Because if a steep uptrend is present, then it's reflective that there is more speed and momentum in the market, and there are more buyers overwhelming the sellers. And this is what we want in order to perpetuate our long position or our long trade. Obviously, as traders, we want to be hitting target in as quick a time as possible rather than trundling in and out of a laggard. Because the longer we're exposed to the market, the longer we are exposed to random chaos that is the market. And of course, anything can happen at any time. So if we're in a long position and we quickly hit our 2 or 3 or 4% target, it's far better than waiting longer than we should. Because of course, if we kept waiting, then we're kind of kept out of other trades we might otherwise be in, and we're also exposed to the random risk and movements of the markets. So a very handy way of objectively seeing whether you're in a steep trend is just to simply imagine a clock face. And what we want to do is find an upward trend facing between 12 and 2 p.m. based on 6 months worth of data on the chart. Okay, because of course if you have like 2 years worth of data on the chart, it would be a different gradient. But if we've got between 12 and 2 p.m., then that's a sign that the trend has a good steepness to it and good momentum and speed to follow. So you can reasonably expect your trade to hit profit target with minimal time waiting around, dilly-dallying. And sure enough, if we have an upward trend, yet the momentum or the gradient of the price action is between 2 and 3, we can see for a fact that it's not steep, it's moving sideways or closer to sideways and up, and that's where we can expect to wait a lot longer. And you might, for that reason, decide not to even bother taking the trade in the first place, because we haven't got momentum, speed, and conviction in the participants in the markets, or even the governing participants in the markets who are taking control of the trend, to really be on the side of our trade. So 12 and 2 are the magic numbers on the clock face if we're looking to do that. Okay, and by the same token, moving averages are also a very good way to objectively gauge the steepness, momentum, and success of your cycling price action. We know that there are lots of different moving average combinations out there, but supposing you did decide to use the 20, 50, and 200, we use the 20 and the 50, exponential moving averages, the order, angle, and separation of them are pretty important. So what we want in an upward trend, where we've got higher highs and higher lows, and we're looking to buy off the back of the next pullback, is the 20 moving average to be above the 50 to be above the 200, like so. So we've got price action nicely going up, making higher highs and higher lows, 20 above the 50, 50 above the 200. Angle, again, the moving averages, or the 20 moving average, to be between 12 and 2 p.m. And of course, the separation, i.e. the gap between the moving averages, is pretty important. Of course, the wider the gap between the moving averages, the better it is, essentially, because it's a sign that price action is running away quite nicely in an orderly fashion, and a predictable one at that. So remember the acronym OAS, order, angle, and separation, and you'll find trend trading that little bit easier, and logical for that matter as well. And it is unsurprising that in a downward trend, we've got a similar set of rules, except the other way around. So here, the trajectory of the trend is down, making lower highs and lower lows, lower peaks and lower troughs, and interacting with the 20 moving average here to the point where we can reasonably expect it to go south again or sell as we're making lower highs and lower lows, and we've reacted to it before. We can reasonably say that based on probability, it's going to happen again. And of course, even though this is a drawn example, we'll get to the real ones in a minute on the charts. Don't worry. Yeah, it goes down, makes a new lower low, and then comes back to pull back. And this is essentially a very predictable cycle. They happen more often than you expect. We just need to be patient and wait for them, because markets do occur in stages. They chop, trend, and range. The trick is, or the skill set, should I say, is waiting for the conditions to be right, because what a lot of people do is they simply want to be gung-ho and jump onto anything that moves. That's trades I'm talking about. and just simply be silly with it because they think that trading is easy money when it's a net sum of all trades over a long time frame, which makes the trader not your ability to get in and out of as many trades as possible just because you're in front of your screen and you think the market owes you something. The market owes you nothing. It owes me nothing, but what it does owe you is organized chaos, where we can see from our strategy that there is likely to be something based on a bunch of evidence, and we look to take advantage of that evidence. Okay, so, by the same token, we've got lower lows, lower troughs, lower highs corresponding with lower peaks. And this gives us the predictability that it's likely to continue downwards, making lower highs and lower lows. That's all we want, really. And similarly to an upward trend, when we suddenly make a lower high, in a downward trend where we're making lower highs and lower lows, very nicely and steadily and graciously, only to find that suddenly we're making a higher low here, as you can see, where it hasn't quite gone and taken out the low of the previous cycle. That's a bullish sign. You can even read this out to be like a double bottom if you wanted to. But that's a sign that it's probably not a good idea to continue your short position if you are short already, or it's not a good idea to go short right now because it's a sign that, well, the bulls are coming back into the market. Here, where it's just the lowest point it can go, is a sign that there's value amongst the buyers to buy there. It's forced the price upwards, and that's where it's gone. So just to recap, as a warning, when price action fails to exceed the previous swing low and makes a higher low, that's a sign that the trend is starting to bend. It's no longer your friend. And the cyclicity there is not looking anymore that much predictable, so it's time to get out and move on to another currency pair, because there's always going to be something else to trade. So just like as we were talking about the upward trend in a downward trend where we've got lower highs and lower lows, the steeper the trend, the better. And of course, the steeper it is, the more reflective it is of having more speed and momentum, which will of course be in our favor. And of course, just like with the upward trend again, we can imagine a clock face, except instead of between 12 and 2 p.m., we want our trend, our cyclicity, to be facing between 4 and 6 p.m. here. The steeper the better. If it's between 3 and 4, then we can say quite lucidly that there's not much speed and momentum behind it, or comparatively not much speed and momentum behind it. And of course, if we're between 4 and 6 p.m., then we've got a decent trajectory on it, which will mean that we'll be able to essentially hit target a lot faster and a lot sooner than if it was a little bit shallower, the trajectory of it. So again, with moving averages, we do use them for the order angle of separation for the downward cyclicity, just like we do with bullish cyclicity. And of course, we look at the order angle of separation again. Supposing we've got the 20 below the 50 and the 50 below the 200, that would be a very good order of them. It's a sign that the shorter term sellers are controlling the shorter term bulls, and the medium term with the 50, and of course the 200. So with the angle, we generally want the 20 moving average as it's corresponding with the most timely or relevant recent price action. We would like this pointed between 4 and 6 p.m. It doesn't matter so much about the 50 or the 200, as it's very seldom that you're going to get the 200 and the 50, given that they're a net average of the last 250 periods of time. So we want to really look at the most recent moving average for this, a requirement of it being angled between 4 p.m. and 6 p.m. And the 20 moving average, 4 moving average bounces, is the moving average which has been backtested to have the best success out of all of them. So you might want to bear that in mind. And of course, with the separation, when we're looking at our order angled separation profile, the bigger the separation is, the better it is for our trade. So this is essentially what we look out for when we're looking at cyclicity. Order, angle, and separation, higher highs and higher lows, or lower highs and lower lows. The trajectory of it on the clock, and that's it really. Nice and straightforward. And of course, this is only for a trending market. If markets range, when they're just moving sideways, you don't really look at cyclicity that much because, of course, when they're range bound, we just get price action ping-ponging between two levels. Really, if the market's choppy and it's indecisive, we just want to step away, put the mouse down, and walk away from your computer. That's the best advice we can have for you. So now for the practical, we'll just take a quick look at pound Swiss. And as you can see here, going along the lines of order, angle, and separation. For the order, we've got the 50 EMA below the 200 and the 20 EMA below the 50. So we've got the right order here. We're starting to make lower highs and lower lows. And we can see here that price action is taking a relatively steep trajectory to the downside. It's come back to test the 20 moving average in advance of making a new lower low, like so. We can see at this point here that the 20 moving average has been respected for the third time. It got respected here once, twice, third time. So if we come back to make another lower low off the back of a retracement to the 20 again, we've got a high test here, old support becoming new resistance as well, then we know full well that based on cyclicity, based on the fact that we've got another instance where we've got respect for the 20 moving average, a lower high, and for other criteria, we've got old support becoming new resistance. We've got a bona fide trade here. But going along the lines of cyclicity, we've got a decent direction as well, facing between 4 and 6 p.m. on the clock. And cyclicity is making lower peaks and lower troughs until we are at a point where we have a higher low made, for example, like here. We even have another instance where we can trade this, like so. We have made another lower low here, followed by a lower high, another high test off the 20 moving average. Remember what I said about the 20 moving average generally being the best one to trade off, given that we've got the confluence between the medium, long-term, and short-term buyers and sellers, that in this case, it's a seller's bias. And the one thing we have in common is not only are we making lower highs and lower lows, lower peaks and lower troughs, but the 20 moving average has been respected multiple times. We've got 1, 2, 3, 4. This is the fifth time it's been tested, and we've got a high test with the open and close below the 20 moving average here, which gives us a fantastic opportunity to short for the previous swing low or indeed a lower low. I'd always rather go for a higher probability and accept a lower reward by simply targeting just a little bit above the previous swing low, like so, to this point here, around about 13945. His target, and cyclicity is still looking very good. It's still making lower highs and lower lows. We haven't got our higher low yet. In fact, we're off the Richter scale here. We come back, still got a lower high here. It's tested this level like so. Old support has become new resistance yet again. However, alarmingly enough, looking at this, there's one nuance which is broken down, and that's the respect for the 20 moving average here. And price action for the first time in, well, about 3-4 months is actually above the 20 moving average. So us traders, that would be an alarm sign. We do not want this to continue on, and we would not really like the look of trading this one for that reason. One of our main reasons for trading it has broken down. And unsurprisingly, we have this instance where we've got the previous swing low been taken out by this one here, and we've got a higher low now. That's the warning sign. As soon as we make a higher low, like so, then that's a sign that our trend, our friendly trend, is starting to bend, and that any short bias is now going to be put on hold, and we're going to be looking for a continuation, potentially of an upward trend, before we can even go long. So I just want to illustrate to you here that we've got peaks and troughs, lower highs and lower lows. So we've got a peak here, and we've got a lower low here, a lower trough, and then we've got a lower high here, a lower peak, and then we've got a lower low, a lower trough, in advance of a lower high, in advance of a lower low, a lower trough, and a lower high here. And just for your information, well, on the topic of cyclicity in this example, we say we only trade with the trend and with phase one. So we just want to illustrate to you now that at the point where phase one we're interested in. So this is phase one with the trend from where we make a lower high to a lower low. That's phase one. We're interested in that area. However, we're not interested in phase two, which is the retracement. We do not want to be trading with that at all. And phase two is where we make the lower high in advance of the lower low. The phase two is from where we make the lower low to the lower high, which is against the trend. So anyone going long here at this point, like so, will quite frankly be under a lower probability of success because it's against the overpowering trend. Whereas us, if we go with the trend, i.e. phase one, we would simply be interested in just taking the lower high to the lower low, like so. And there's phase one, this area here. So you've got phase two, phase one, and phase one again. So looking at the chart again, I mean, it's quite seldom that you see a perfectly steeped area of cyclicity with all the moving averages fulfilling the order angle and separation which we require. However, when you consider that we've got a year in order to await these formations, and that's not the only strategy we trade, it's absolutely okay. Less is more. We're looking at New Zealand CAD here, which is a decent cross-currency pair, and we can see that even though we've been fumbling around for the best part of a month and a half, we are now starting to make lower highs and lower lows here, like so. We've got the 50 just about to cross the 20 moving average here, and that's a very good sign. These are two dead crosses just about to occur. They've already occurred, and what we're looking for is just the continuation of this ebb and flow, so that if we do continue to make lower highs and lower lows, then we can simply take advantage of a pullback to, say, the 20 moving average in the future. And sure enough, we've got a little way to go if we're waiting for the moving averages to give us the separation that we require, like a decent amount of separation. This is pound New Zealand, and a prime example of moving averages facing towards 3 o'clock. We've got the 50, 20, and 200 all facing sideways. That's a very objective measure for us, that there's nothing going on, there's no trend. Of course, you can see that with the lack of cyclicity. There's no real consistent lower highs or lower lows, or higher lows and higher highs. So there's no trend here at all, so we can move on to something else. And also a case with dollar yen, where we have, sure enough, a very gentle downward trend with lower peaks here, although there's a decent level of support here, which is going to get in the way of any kind of reward. However, you can see that the 200, the 50, and the 20 moving averages aren't really facing in any logical direction, i.e. on our clock face. They're facing more towards 3 o'clock, between 3 and 4, than 4 and 6. So for that reason, we could objectively say that there's a lack of speed and momentum in the market. And you are very legitimate in saying, for that sole reason alone, I ain't going to take the trade, I'm going to move away and turn the other cheek and wait for the conditions for the speed and momentum to come back. However long you're waiting. But do remember, we've got about 25 more currencies to look at, so don't get your heart set on one currency on its own, or get too disappointed if it doesn't manifest the kind of setup which you want. Now on the flip side, we're looking at upward moving cyclicity, and here we have the Kiwi dollar. And this is a currency which has traditionally been bullish, hand in hand with its high interest rate, which it has compared to Europe and America, certainly. But regardless of that, we trade what we see, not what we think. And we've got the makings of an upward trend right here, with the key higher highs and higher lows. And we can start to see here that, okay, we've got a respect for the 50 moving average, not so much the 20. However, the 50 moving average is a bona fide moving average to trade off. Having just made a higher high here, we've had our phase two, the pullback, the retracement, whatever you like to call it. It essentially means the same thing. It's when the market breathes in before it breathes out again and makes a higher high. Comes back having tested the 50 moving average. Double bottoms, makes a higher high. Then comes back, makes another higher high. or very much a higher high. So we have cyclicity here, ebbing and flowing upwards. The old expression, the bull climbs the stairs, the bear falls out the window. You can reasonably say that any upward trend is going to be less steep in the upward trend as the steepness in a downward trend, because the bear falls out the window, as the old cliche goes. So here we see the momentum of it crashing down, and this is our lovely upward trend momentarily invalidated with this volatility bar. This is possibly non-farm payroll day. This is what happens on non-farm payroll day. We get these huge wild moves. So by the same token, we have a very good example of upward cyclicity here, demonstrating the fact that the bulls are not quite as strong as the bears in the downward run. So here we've got a key trough, a higher high, a peak, a higher low, a trough, and a higher high, a peak. And this is where it all breaks down, unfortunately, from there onwards. However, when we consider that we have the higher low here, like so, and we've got a decent activated bar for our long, moving upwards, then that's a very good long opportunity. It's just all about the management of the trade. So when we talk about phase one and phase two, again, in the upward trend, we've got phase one, which is with the trend, from the higher low to the higher high. And then we have the case where we've got phase two, which is the higher high to the higher low. This is where we don't want to trade because it's against the overall trend. And phase one again, where we have made the higher low and we're looking to make a higher high again, all the way up here. So phase one with the trend, phase two against the trend. But while I say that the best price action interacts with moving averages is generally off the 20 moving average, we can sometimes get steeper cyclicity. Like look at pound yen, for example, on the daily, where we've got a continuation and retracement back to the 200 moving average, like so. It's very seldom that happens, and you can see here that although we've got lower highs and lower lows for the most part, it is very gradual as well. So we haven't really got the speed and momentum. However, if we get one test of a moving average, while we consider that 3 tests on the trend line validate it as being a bona fide technical point where we can expect to trade on the 4th bounce with a high probability associated with it, we only need one previous touch on a moving average. And whilst we got one test on this 200 moving average, if we had a sufficient reversal bar of this moving average as well, the 200 on the second occasion, that's our trading opportunity. Here we've got a fantastic opportunity here on the 200 moving average, because not only has it tested twice before and it's held on the 200 moving average, we've been making lower highs and lower lows, albeit very long term. We've got a high test bar rejecting the 200 and then a decent move downwards afterwards. So there are lots of different moving average combinations out there. There are dozens, hundreds in fact. However, it makes a lot of sense to really kind of go with the moving average combination, which is widely used in the market. And the 20 and the 50, for sure, are the ones which have worked best for us historically. And price action has interacted off the 20 out of those 3 the best for us historically as well. Even if you do see interaction with the 20, it's okay to do it off the 50 or the 200 as well. Just do not expect the moves to happen as quick. Right, I think we can call it a wrap now for cyclicity. Happy trading, guys.